Now, when we were putting this together, actually, it was interesting. We first talked about doing this. It was January, and really it was the worst of times because we'd just gone through a horrible December quarter. To use phrases, it was a winter of despair at that time. Roll the clock forward 2 months' time, suddenly we are in a spring of hope because markets have rebounded and fully rebounded basically from what they fell in the December quarter. So we're now not quite in the best of times, but certainly in a lot better times than we were just 2 or 3 months ago. We're going to talk a bit through that. We're going to talk about how we performed very well in last year, but happy to say we're continuing to perform pretty well this year as well. So we outperformed last year in a down market. We also, currently anyway, are outperforming on the way back up again. Let's look at what happened last year. So we started, if you roll the clock back 6 months ago or even 12 months ago, everybody was worried about rising US interest rates, and they did rise. They rose 3 times and now at 2.5%. Everybody was worried about what's going to happen when quantitative easing stops. Well, it has stopped. The US Fed is actually reducing its balance sheet. It is tightening up. It is selling bonds rather than buying bonds, so it's actually pushing interest rates up both at the short end and the long end. What's going to happen there? And what's going to happen if short rates invert, or the yield curve inverts, or basically short rates rise so much that they go above bond yields? And we almost got there. And I'm glad we didn't get there because to me that's one of the best indicators of the next recession is if short rates exceed long bond yields in the US. It has been the harbinger of every recession since basically World War II. We never quite got there. We got very close in that fourth quarter, but we didn't actually get there by our best measure. So there was a lot of doom and gloom. But the other side of things was there were signs of a slowing economy. Interestingly, less so in the US and more so in the rest of the world. Actually, Germany had a negative quarter of GDP last year. Australia, we had almost a negative. We had 0.2 in the December quarter, but we certainly saw house prices falling, car sales falling dramatically. So certainly building approvals falling. So Australia is slowing. And China is still growing, if you believe the numbers, but it's growing at a slower pace, slowest pace for many years. So there's certainly some negatives on the GDP side. And then we've got the trade wars and what's Trump doing. All these things, everybody got worried about these things, particularly in the fourth quarter, and that's when markets fell. And for the first 8 months of the positive returns for 2018 all fell in a hole, and we ended up with negative returns for 2018. So that's what happened. There is a silver lining though. And this is quite a big difference and a big change just in the last couple of months. We've shown this for the last few years. We look at cash rate expectations now. In Australia, it's basically dead flat, or in fact, slightly down. This is actually off bank bills, so it's probably not necessarily indicative of the RBA cash rate. It's more of the funding costs for banks, because it is actually above 1.5. But if you go to the rest of the world, it's also pretty much dead flat, including the US. Basically, the US Fed has almost come out and said we're on hold now, and domestically the RBA has done the same. So this is actually, I think, a very interesting chart. To me, probably the best chart that we're using today, which shows you how cash rate expectations in Australia have completely flipped in the last 4 months or 3 months. So if we start here, this is cash rates. We've been for 31 months at a historical low of 1.5%. But these little curves here show where the market expects interest rates to move. And for basically ever since they got to 1.5%, most people have been thinking, when are they going to raise rates? What's happening? So it was quite a strong, they thought in December 2017, people were thinking we're going to have 2 interest rate rises over the next sort of 6 or 8 months. Actually, it started to weaken a little bit, but as we went through last year, people were still expecting interest rates to rise, but a bit gentle. This is the latest one there is November, and it was still a positive rise. And then bang, by the end of December, it had flipped from a positive to actually the next move may be negative. And right now, it's actually potential of 1 or 2 cuts. And the RBA has actually confirmed that. They've come out and said we're no longer on a tightening bias, we're on a neutral bias. So the next move is just as likely to be down as up. The market is actually predicting that it's down. So there's this massive change just since the end of November last year. And that's important because it means, I think that's why equity markets have risen dramatically, is because We're no longer in a interest rates are going up environment. We're now in an interest rates are flat or potentially even falling here in Australia. And you know, you value equities based on that. We've seen a big rally in equities now that people are not that worried about interest rates anymore. So returns were rubbish last year, but we're an income investor and dividends were actually pretty good. Global dividends rose 13% last year, year on year, and it actually accelerated in the fourth quarter. So in the fourth quarter when share prices were falling, dividends paid in the fourth quarter of last year compared to the fourth quarter 17 rose 17% for global equities. So this is ex-Australia. The strongest growth was interestingly in areas like IT, which we don't really have much here. Stocks like Broadcom increased dividends by more than 50%. And whilst the US had massive tax cuts and good earnings, the actual strongest increases in dividends were in countries like Austria, Singapore, and Germany, and they all rose their dividends by more than 25% as a country last year. So very strong rises. Australia was a bit of a laggard. We actually only increased our dividends by 8%, so we were about 5% under the global average. You can certainly see the strength in global dividends over the last couple of years as they've been strongly rising. What's held back Australia? Well, we've shown this sort of chart for a while. The problem with Australia is that our market is dominated by banks and Telstra, a few other financials, and clearly things like the Royal Commission have held the banks back. These top 6 stocks, and there's only one that's actually increased its dividends by any extent in the last 12 months, is BHP. Those top 6 stocks now represent not quite, they used to represent more than half of the dividends. Now actually, because they haven't grown their dividends much at all, and in Telstra's case it's actually had big cuts in dividends, they're now slightly less than half the income of the Australian marketplace, but it's still incredibly concentrated. And the problem for the banks and Telstra is that's what the market has done over the last couple of years. You can see the fall, you can see the rebound in the last couple of months. That is Telstra's share price. It has fallen dramatically, but it's just fallen in line, or maybe not even in line with its dividends. Do you know that today, if you look at Telstra cut its dividends last month again, Telstra's ordinary dividend is now 68% lower than it was 2 years ago. Its total dividends aren't quite that bad because it's paying a special dividend, but so if you add the special with the ordinary, its dividends have only fallen 48%. That's pretty much what that share price fall is going to be, particularly if you go back a little longer. Problem for Telstra, and it's our view, is when the NBN payments stop, the special will stop. So I think in a couple of years' time, the ordinary dividend of Telstra will be 68% or even lower than what it was 2 years ago, and there'll be no special. And so Telstra will have cut its dividends by about 70%. So I don't think there's too much hope there. And the banks have been doing it pretty tough too, Royal Commission. They haven't cut their dividends, but they just haven't increased it. So here's an interesting thing. If Telstra is cutting its dividend, if the banks are not increasing their dividends, but they represent nearly half of the market, the other guys have been doing some heavy lifting for our total dividends to increase by 8% last year. And it has been the case that stocks like BHP have returned massive amounts of capital. And dividends, when we look at dividends, we don't include things like buybacks, which we'll talk about in a minute. Globally, though, it's a different picture. We've shown this chart before, but I think it's a very important chart as well. When you look at the previous pie chart, it's like Australia's incredibly concentrated. When you look at this chart, you think the MSCI World ex-Australia isn't very concentrated at all. The top 6 stocks, and this is the percentage of dividend income paid by the top 6 stocks, is pretty small, less than 10%. But the other thing is you look at the names there, there's no massive concentration of industries. They're not all banks. There's only one bank. There's actually 2 IT stocks, Apple and Microsoft. They don't pay huge dividends, but they're such a huge companies that their dividends still get in the top 6. And you've got AT&T and Verizon, which have done a lot better than Telstra. They don't have NBN problems. And you've got one resource stock or oil stock, which is ExxonMobil, make it up. So just that chart alone, you can say, well, hell, it's a lot better diversified than Australia. You look at some of the other names we've had, a lot of household names globally as well. So, you know, chalk and cheese when you compare them, and global dividends are growing very strongly, particularly in Australian dollar terms. The other thing is that there are just so many companies. In Australia, we really, we benchmark to the 200. Our universe is really 300 stocks, but the reality is only about 200 decent dividend payers in Australia. We track about 6,000 stocks globally, and in some months like March, about 2,000 stocks go ex-dividend. So there's a huge choice compared to the number that we have the opportunity set here in Australia. So there's plenty of dividends globally. A lot of them are low yielders, but if we look for income, which we do, we can actually deliver good income, as Matt said before. We now have a 3-year track record on our global shares income fund, and we're delivering 6% income out of that fund compared to the benchmark 2, partly because we look for income, partly because there are plenty of opportunities, and we'd use the same rotation strategy we have here in Australia to go and seek out and grab the dividends and move on for other opportunities. So when you look for income, there is actually plenty of income there, we have delivered on that income, and that's after fees, by the way. So we're actually generating about 7% before fees. Moving back to Australia, it was a pretty strong year for us, but it's consistent with the history of our fund. We went and did the upside and downside capture. What does that mean? Upside capture means if the market's up, how much of the return of the market do you get? Well, if you get more than 100% of the upside, you're actually outperforming. That's good. But it's interesting that we actually do better on the way down. We only get 91% of the down. When in down markets, we actually don't go down as much as the market. In fact, our alpha or outperformance in down markets is about double our outperformance in up markets. And I'm happy to say, even though it wasn't all down last year, but actually, it's only coincidence, but we actually added 2.7% after fees last year above the benchmark for our Australian shares income fund. It's been a consistent outperformer. It's a well-diversified portfolio. It's not a shoot-the-lights-out portfolio. It's a well-diversified income portfolio. But you can also see that we've done well in the rebound in the last couple of months on there too. So we've consistently done pretty well. How did we make the money last year? If we added 2.7% after fees, so actually about 3.6% before fees, where did the outperformance come from? Well, strangely enough, we're an income fund, but the way that we manage the fund is we're not all about the banks and Telstra because our performance would have been pretty rubbish. We made a lot of money out of stocks like BHP, South32 and resource stocks, which you don't think to be good income stocks, but right now, strong capital discipline, and they are paying out a lot of income, a lot of franked dividends. Macquarie was been a top pick in financial services for the last few years. Qantas, not an income stock, but it's done well and it's started to pay some dividends back. And Woolies has done okay, although it had a bit of a disappointing reporting season. But we also made a lot of money by avoiding the losers. And we want to talk a little bit more about that. But underweights of Origin and Lend-Lease and pretty much having no AMP last year meant that we had good outperformance. And, AMP did actually look pretty high income, but, we didn't want to fall for that. A little more about outperformance and why. So one of the areas that we made a lot of money out of last year, which may not be traditional income stocks, but is resources. And the resource stocks have changed their stripes or their spots over the last couple of years. Instead of being very capital intensive and basically only returning about 30% of their earnings back to investors, they've significantly increased their payout ratios, they've reduced their investment, and they're releasing capital as well as dividends. BHP conducted a $7.3 billion Australian dollar off-market buyback, which returned something like $3 billion in franking on top of that. They also paid a special dividend the same size just in January, end of January. They paid another $7.3 billion plus $3 billion in franking. The buyback itself, we love these buybacks, which is why we didn't like Woodside wanting to do a buyback just with Shell and not with other investors. BHP's buyback was worth 21% for retirees or tax-exempt investors. That is the low-hanging fruit, and most managers don't actually participate, but because our clients, we know who our clients are, we participate for them and get them good value, good franking, and good income. So the difference is if you're selling the market, you would have got 21% less than if you actually participated in the buyback. So we look for those. Rio did another one. There's a couple more on the horizon. Caltex have already announced one. We have a paper on our website looking at that. That looks pretty juicy. And we expect Woolworths to do one as it sells its petrol assets. So that should happen fairly shortly. We think the announcement will be pretty soon. So we look for these opportunities. But we also make money by, we call it winning by not losing. If you can avoid the underperformers, you've almost, you've got a head start in winning. This is a little slide. we got price in the dark blue line, and yes, AMP's share price has basically halved, or even a bit more than that, over the last 12 to 18 months. Look what happens to yield, and this is the trick about yield investing, is don't always get sucked into the highest yielding stock, because as AMP's share price fell over the course of the last 18 months, its yield on a historic basis, and we've grossed it up for franking, so we don't just look at the cash yield, we always look at the amount of franking that's likely to be released. The gross yield actually went up. It went up from a fairly nice 8% to, you could buy it a month or two back at a 15% growth yield, which looks fantastic, doesn't it? Until it came out with its results and cut its dividend. And that is where you see there that the yield rose until it fell, which is when it announced that it was going to cut its dividend, and doesn't look nearly as great. A better example even than AMP though is actually the next one, which Mark said, well, I should take this out because Myers had a good result. Well, they didn't have a good result. They had a not bad result. They had the result that they just announced was about the same as last year, but they're not paying a dividend. The share price has fallen. Again, in Myer, they've fallen, pretty much halved the gain over this period. There was a time early last year when Myer was trading on, if you're a yield investor, you could get, at one stage about a 20% gross yield. Now, if you're looking for income, 20% looks fantastic until bang, they cut their dividend and then they cut it again, e.g. they don't pay a dividend. If you're an income investor, you have to have good discipline, do not get sucked into the dividend traps. So you should avoiding these stocks is pretty key, and we have refined our process to try and avoid these. It seems as though that some income managers and some simple passive strategies just say, buy me the highest yielding stock, and they're going to buy the AMPs, they're going to buy the Myers until they cut their dividends, and then they have to sell them at a loss. And if we just look at the results, I mean, it's actually been a record year for our domestic income fund. Now, this is a bit skewed because the overall market's increased dividends by 8%, but there's been some special dividends that we've made a lot of money out of. But those big buybacks from the likes of BHP and Rio have also provided a great kicker in terms of the income of our fund, because the buybacks are largely in the form of a fully franked dividend. We've had the best year ever in income. Normally our fund generates about 9% gross. We've generated 12% gross. I actually expect by the end of this financial year, by the end of June, that number will be about 14 or 15%, particularly if we have the Caltex and Woolies buybacks as well. But also we've got a lot of specials and things that have just happened recently. So it's been a great year for income relative to an index. I would say the index doesn't include specials in it. That's just the way that S&P do it. They don't actually include specials in their dividend calculation. You go figure. I'm not going to win that argument, but it's been a great period for income, and there's a little bit more. One of the reasons also has been the franking credit issue, because a number of companies, including our own LIC, have said we'll pay specials and clean out our franking as much as we can before the ALP get in, if they get in, assuming they get in. But I also want to just very quickly share with you a new factor that we've added to our process. We're always looking to improve how we pick stocks, or in this one's a bit of how we can, again, win by not losing, because we want to avoid the red flags, which is where it starts. But as you'll see, it also helps us pick the stocks that have no red flags. So Dr. David Allen joined our team about a year ago from JP Morgan Asset Management in London. 15 years experience, a lot of experience running funds. He ran a dividend opportunity fund actually in Europe. And he brought with him quite a bit, and we've done a bit of work on this too, is like when you invest in companies, you do find that you've made mistakes or what have you. Or we had a Mount Gibson Iron, I think, did a bit of a thing on us a couple of years ago because they had a stacked board and they decided not to pay dividends, and we didn't like that, etc. But the problem was they had poor corporate governance, and that's not a great sign. So we have a bunch of indicators about poor corporate governance. We have a bunch of indicators about the quality of the accounting, or even a simple factor like unusual auditor. If PwC, which audits our accounts, they're a global top 4 auditor, a lot of reputation on the line. If Don Hamson and Sons is auditing our funds, you might not have as much faith in them, right? So if it's an unusual auditor, which Madoff had his mate upstairs auditing his Ponzi scheme fund, we use these indicators. There's actually about 100 of them, But the proof is really in the eating. If we look at these, we have a simple methodology. If the stock doesn't pass the test, it gets a red flag. And we just then count up how many red flags the stock has. What we do then on this chart is we look at what is the subsequent 12-month performance after, like we analyse the number of red flags at a company today, and we then look at the performance for the next 12 months. So this just says if there's 0 red flags, so if a company has none of these bad indicators, a red flag's warning sign, it actually goes up about 10-12% per annum. These are not relative, these are absolute. 1 or 2, it goes up about 10, 3 or 4, a bit less. But you can see the thing there is, if you've got 6 or more, you actually fall 12-15%. The difference between having none and having 6 or more is about 25% per annum type performance. So A, you want to avoid the red flags, that's for 6 or more, but B, you want to probably buy some more of those things. This is global because we first implemented it in our global fund, but it works exactly the same, if not even better, here in Australia. The worst 6 red flags actually go down about 20% versus a similar sort of outperformance on the upside. I'll give you a bit of flavour of what stocks in Australia have 6 red flags. Well, Blue Sky Alternatives, you know the story about that one. It's had a bit of a tough gig. We were up in Brisbane yesterday, got the kick into Brisbane, but it had 6 red flags. Quite a few of the little dodgy miners have 6 red flags or more as well. We risk of me not to talk about the franking. Some people call me Pop, the protector of the pensioner, and those sorts of things, but we've certainly been writing a number of papers, appearing in the press, appeared at the inquiry that's going on at the Bondi Junction RSL. We put a submission into that inquiry as well. I think this slide sums it up. We've got a whole presentation on this stuff, but I think this slide sums up the problem about why it's discriminatory, because here I've got a very simple example. I look at how much money an individual is. It looks exactly the same for a couple, but a pensioner. But let's say you have a retiree, an individual owns their own home, they're retiring this year, which is important because they don't get exemptions. How do they invest? Well, they can invest in a large super fund that pays tax, and a fund like Australian Super has come out and said, you'll continue to get all your franking even if you're in pension mode if you invest in our fund. We've got plenty of accumulation members, we pay plenty of tax, so we'll use all your franking and pay you for that franking. That is the existing situation. At the moment, all super funds get a refund, and so they can get full refund of franking. The problem is, under this proposal by the ALP, if you are in pension phase super and you retire this year, you will get no refund whatsoever. So suddenly, pension phase self-managed super funds, if this legislation goes in or proposal goes in as suggested, will be fairly inefficient for a vehicle for holding Australian shares for retirees. I'll flip to the bottom. As an individual, you'll get a full refund if you're on the pension, and you'll be on the pension if you have less than $564,000 worth of other assets because you own your own home. You won't get a refund though if you don't get the pension. Even if you have $50,000 more assets, you're not going to get any of those franking back. You can use the franking to offset against tax, but if you're only earning $30,000 like my mother was, she didn't pay any tax, she had $8,000 of franking, she would have actually lost 28% of her income, which meant that she would have had less earnings, less income than the actual full age pension. But she wasn't eligible for the full age pension. So it's quite discriminatory. And then is an interesting one. I have this one here, which is super fund receiving partial franking credits. And that is, if a fund, and there are a number of these, some of them are retail funds, actually have quite a few accumulation members, but they actually aren't in a net tax paying position because their franking credits just exceed their tax payable, then you'll start to lose some of those franking. And it's interesting that last week or the week before, Colonial came out and said of its two, and I can't remember which one is which, but of first wrap and first choice, one of them is in this position and the other one is in this position. You'll lose some of your franking here, but you'll get it all in there. So interestingly, if this legislation comes in, you'll have to consider whether platforms are able to use the franking. But clearly this chart highlights that you should have your clients up here if this comes in, and that doesn't look particularly nice. I would warn people though, let's not react too soon because the ALP have to win the election. That sounds pretty likely at the moment, given what the coalition's doing, shooting itself in the foot on many issues. But it needs to get it through Senate. And the current government hasn't been able to get a tax cut for big companies. This is a pretty divisive issue. Most of the crossbench senators have said they don't believe in it. They want exemptions or grandfathering. The Greens have said they want grandfathering. Others have wanted exemptions and those sorts of things. And it's subject to this inquiry for what that might be worth. I think it's very political, but they're at least looking at all the avenues and poking holes in what's wrong and what's right about it. You can join our petition for what that's worth. I'm not sure that is going to have a lot of weight. The ALP have said, we don't care how many people sign your petition, but there's a lot more evidence, and there's a number of papers on our website. We've written 3 papers and a submission. So if you wanted more information about that, you can visit there or come to one of our lunches where we can go into this in a lot more detail. But I think this chart also sums it up. So this is our forecast for income for the various asset classes. It's done at the start of this year. Markets have risen a bit, so the yields would slightly come down. That's how they work. But very low interest rates for bonds and cash. MSCI World, a bog standard index, 2% yield. REITs in Australia, 5%. There's basically no franking. And if you can get the franking, Australian shares will still give you about 6% income, was our forecast at the start of the year. If you lose the franking, if the ALP proposal means that you are in a situation that you don't get the franking, your yield or your cash yield goes down to about 4.5%, which is still better than most of these other things, and there is potential for capital growth. It is an abnormal year for us, but our forecast for this calendar year for our fund is that we think we'll get somewhere around 11 or even more % gross yield. A lot of that's in the first half of the year. If you can't get the franking, you'll get about 8% cash yield. Now this is abnormal because of the buybacks, because of special dividends, etc. Normally we would expect to get about 9% growth. That's what we'd probably expect next year, and about 6 and a bit cash yield out of our Australian fund, which is about what our global income fund is getting. If you lose franking, our domestic income fund and our global income fund will be delivering about the same cash yield, which is still pretty good at 6% compared to other assets around there. And remember, they are well-diversified portfolios. So we can still deliver good yield even if there's no franking. So finally, just to sum them up, I've probably gone over time, but interest rates now are basically remaining low, could even go lower here in Australia. There is a lot of political risk around. It's not just franking, it's capital gains tax, it's negative gearing, it's other things. We do think dividends will still be strong, although I think there's going to be quite a few more specials and extra dividends paid before June 30 this year, because the ALP think that they might, their proposals come into place from 1 July. We think we'll still be able to deliver significant levels of income. 6% is what we've delivered for the last 12 months out of global, and 12% domestically, although that is a bit higher than our normal 9%, which in itself is still pretty good.